All right, we're gonna get rolling here. Welcome to our little info session here on how to use VA eligibility, VA benefits to build a real estate investment portfolio. We did this topic about a year ago,
Here we go.
and it was time for a refresher. But what we will do, just some housekeeping items up front. What we'll do is with the replay of this, we'll include that info session as well. So if you want to review that, we'll include that with the replay session, which we will, as we always do with these classes, we'll get it added to the Wake Up Real Estate YouTube channel. We'll get it added to the site at wakeup.realestate. And I set these up so that you can watch the on-demand replay on the Zoom link that invited you here in the first place. We have, as I usually do on these sessions, Jordan Syers, who is our guideline guru, among other things, and get into the the hows and the whys as to why somebody, how they can and why they would use VA eligibility to build an investment portfolio in a minute here. But I want to encourage all of you, whether you are watching live or after the fact, if you have questions, A, you can use the webinar chat or the Q&A box live, or B, if you're watching after the fact, you can comment, or C, there will be contact information for both Jordan and I, wherever you may be watching. Reach out to us. We're happy to chat. If it's a technical guideline type scenario or situation, Jordan is the guy. If it's related to marketing or how you can use ideas like what we'll be sharing today to get yourself more clients, generally speaking, that's more my domain. And if you have a client who whether is VA eligible or not, we'd love the opportunity to help them. That said, for those of you that don't know me, first, my name is Schoenly. I've been licensed real estate agent since the mid 2000s. I got licensed on the mortgage side in 2022 for a whole bunch of reasons. Jordan is, despite what you might believe, has been in the industry for over 10 years, has done just about anything under the sun when it comes to the mortgage industry. He's overseen teams. He's led the NEXA Academy, coaching and teaching hundreds of other loan officers just getting into the business or maybe needing some help. And I think the biggest value in my personal experience with Jordan is his ability to problem solve unique and interesting scenarios and situations, and being able to come up with creative solutions where others may not even attempt to come up with a solution, A, or B, helping folks that have been told by 1, 2, or 10 other lenders that, we can't help you. And so this is a bit of a unique topic in the sense that, most people don't realize that this is even a possibility. What we're talking about here, building an investment portfolio with VA home loan benefits. And so, Jordan, maybe we should start with just some basics about VA eligibility, benefits, and options as far as that goes, and then paint a picture as to how someone, or how whether folks listening are VA eligible or are have clients or potential clients who may be VA eligible, helping them build a plan to do just that.
Yeah. I'm also sick today, so I'm not
Yes,
going.
Jordan
Yeah,
is playing hurt here. So
yeah, I do have a fever, so my brain might not turn as well for this. But VA eligibility, just the base guidelines of what we look for and what clients look for. Is going to be 0% down, low credit score requirements or no credit score requirements, as well as no mortgage insurance, right? With that 0% down. I've
yep,
helped many clients create portfolios, and when I say create portfolios, they're not doing anything that's they're not buying a house and immediately renting it out, and, you know, basically buying an investment property. They're doing actually the opposite. But I've helped people build four or five, buy four or five properties and kind of move property to property and put themselves in a position to where they might have 7 units before they buy their first real, doing a first real investment loan.
yeah.
Um, you know, uh, uh, Usually we recommend if I get a veteran that is interested in um, creating a portfolio, we really talk about really what that plan looks like overall. What is our investment strategy? Do we currently have a home? Right. If not,
Mhm.
it's usually easier because we can buy quadplexes. We can do a lot of stuff to where we can buy and move into one side. And as long as I like to use the term leveling up, no one's going to bat an eye at you moving, every, once a year and using your VA eligibility, as long as it makes sense, right? Hey, I'm moving into a larger space because I'm getting married, or hey, um, we need more square footage, or I don't want as many neighbors. I mean, there's just reasons that we have to give. But I've helped people
So
go
as
from
long as you
quadplex
can
to duplex.
justify it, right?
Yeah.
You have to have some justification of some kind, but there are many ways that you can justify. And this is also the case with FHA. We've talked about this on our FHA deep dives, which will include a replay for this if you're watching this after the fact as well. I mean, that also applies to FHA. People, you can have multiple FHA mortgages.
Yes.
It just
Yeah. A
has
lot
to
of
be
people don't realize
justified, and there
that.
has to be a reason.
Yeah, a lot of people don't realize that it is something you can absolutely do.
Hmm.
I've helped a client buy 9 FHA houses,
Hmm.
have 9. So it just depends on the situation and how you review the rule and how it can logically be put together. That particularly was a unique scenario where he had 8 brothers and sisters. So, co-signing and doing things like that is allowed within the rule.
Hmm.
And we just it's a good way for people to get their start more than anything, right? Is how do you use your VA benefits to get your start, or how do you put yourself in a position to where you can have 5 or 6 units before you're even jumping into putting 20% down or 25% down. And uh, Typically we start that with quadplexes, right? Moving into one side. And some people might not think they qualify, buying because in your market, it might be $1 million home. They might be having, a single family resident might be 300,000, but it might be $1 million for a quadplex. We'll use 75% of the rents on the other 3 units, for an example, to help you qualify, help those clients qualify. Um, and get them in a position to where they can purchase that property.
This is an important distinction because we've had several scenarios like this where someone comes and that they apply and we work to get them pre-approved, and the pre-approval amount isn't really going to match up with the reality of the cost of homes in their particular market area, right? So they're thinking they'd like to buy a home where the average home price is 400,000 and their pre-approvals for 2.25. What Jordan is saying is, and what we will often pivot to, or at least present as an alternate option for the borrower, is maybe we should look at a 2, a 3, or a 4 unit where we can use the income from that property to help supplement your income and thereby qualify for a larger, you know, a higher price range. And also, you know, educate them on the idea that, you know, there's a silver lining here, in that you're going to, you know, you're going to begin building an investment portfolio while also taking care of your own needs, and your, you know, providing for your own shelter.
Yeah, absolutely. So that one is you know, especially right now more than anything, we run across those more than often just because the home value, you know, have just
Yeah.
skyrocketed for
Yeah.
people. So that's a good point. Overall, you know, when we're investing this way, uh, we want to make sure that we're keeping the client, like most investors, okay, they want to put themselves in a position where they're not forfeiting as much cash as possible. Not only that, when you have like if I compared a VA home loan compared to a quadplex investment property, DSCR, or, you know, regular Fannie Mae, Freddie Mac investment property, we're talking about probably a 2% difference in rate between the two. So overall, their margins are going to be tighter, as well as you know, they're going to be put in a position where they don't have to put MI down either. So they have a very big advantage if they can start out that way, on having higher margins, less money out of pocket, get the kind of the ball rolling to the point to where now they have some income streams to where they can put some more money down later on.
So that scenario, they buy a quadplex, where if they were to be forced to utilize, let's say, a DSCR loan,
Mm-hmm.
they're going to need 20 to 25% down, minimum 15%. They get into the quadplex with zero down. They're going to have a significantly lower rate. They're going to have a significantly lower payment, not just because of the rate, but because of MI and other factors as well. Then in a year or year and a half or 2 years, they say, okay, I've got this quadplex. Maybe I'm going to go buy a duplex, right?
Yeah.
So I have a 2-bedroom unit in this quadplex. I'm going to go buy a duplex that has 2 3-bedroom units. I get to keep the low rate and the advantage, the leveraged or the significantly advantageous financing on that current fourplex, which means when I'm not occupying the unit and I fill it with income, we're talking some significant cash flow, most likely anyway.
Mm-hmm.
And now I'm going to trade into a 2-unit where I can, as long as it all works out, I can reuse my VA benefits. Now I've got 2 assets where I've got 6 units, where you'd be hard pressed to create a scenario where those 5 units weren't paying for the unit that I'm living in entirely, right? And then a year or 2 later, I can trade into a single family, and now I've got 6 units and the single family.
Yeah, there's 2 things there. One, you only have so many amount of, so a veteran has so much amount and you entitlement. Okay.
Yes.
It's like
Yep.
the VA is willing to give you X amount of dollars, you know, depending on your area. I mean, there's a lot of factors with it, depending on your area, family stuff, you know, a lot of stuff, but you have, you know, a certain amount of entitlement.
Yeah.
Usually after the second loan, you're going to not have that entitlement anymore. Okay. So once you hit the second, like, hey, I'm going to buy the duplex. I just bought a $400,000, $500,000 quadplex. Now I'm buying a $300,000 duplex. And as long as that second loan, there's another rule when you're getting your second mortgage on a VA, it has to be over $144,000. It's called bonus entitlement. You start dipping into that bonus entitlement. So it has to be, there's a wonky rule out there that basically says, hey, it has to be more than 144 grand. But you're not going to typically find duplexes for less than 144 grand in most cases. Now, let's just say on our third house, they want to go buy our single family residence. And we run out of entitlement for half the loan. Like half the loan, we run out of entitlement. It doesn't mean you can't do a VA home loan. It just means the difference have to be 25% down. So if you're buying a $200,000 single family residence, you still get that no mortgage insurance. You still get the lower rate. It's just 25% down of whatever the entitlement doesn't cover. So I'll have clients that even if they've already used all of their entitlement and they can't do anymore, they'll still go and buy VA properties and move into them, do VA home loans just because the rate's better, right? It's better than conventional, it's better than FHA, it's better than everything. So as long as it makes sense that they're scaling up or leveling up on their houses, right? You can take that entitlement all the way through until you run out of it. And that's what
they're likely building equity in those properties as they do that. And hopefully they're also building their wealth otherwise, because they're they should be saving money because they have tenants that are helping to pay their mortgage or paying all of their mortgage along the way. So they can hopefully sock away more to be able to do that 25% to still get the advantages of having that lower rate and having the lower MI, etc. So
I use an example a lot with clients that it's like, hey, I want to get to a point where I don't have a mortgage, or I'm cash flowing that covers enough of my bills. I've had a client specifically I remember is like we helped them buy a fourplex, a duplex, fourplex, duplex, and then we went to single family. It covered everything plus his car loan, right? It covered his mortgage. He had enough cash flow that covered his current mortgage that he moved into, and a little bit more than that. I can't remember exact amount, but I know it covered at least his car. But it put him in a position to where he could just save that money and start buying properties. And now he's a full-time investor now. He retired from the military, and he's a full-time investor that we work, I work regularly with. But his wife even became a realtor over it, over this strategy. So it will open up doors for veterans if they can think outside the box a little bit and put them in a situation that allows them to, to continue to invest, or because most people, don't have that opportunity. They're going to have to put 25% down, and saving up 400 grand. I mean, $400,000 house at 25% down is a lot of money, on a quadplex.
I mean, it's 100 grand. 100 grand. And so the benefit to you, the real estate agent, there are many, but one of them is if you create a plan with and for the veteran, the VA eligible borrower, you're also creating some theoretically predictable future, commission and sale opportunities for yourself. Now, service first, right? Making sure that we're leading with service there, but you're doing good in your community by helping someone who has earned those, these benefits and eligibility. And I think it's always better if we've got I'll call it mom and pop landlords versus, the big box corporate investors who are buying properties in your community, right? So there's the benefit of that. And again, if you help them create a plan for, okay, we're going to start with this threeplex or quadplex, triplex or quadplex, and then 18 to 24 months down the line, let's look at, is it time to trade into a duplex? And then in 18 to 24, now you're getting where, in a typical scenario, you help, the normal first-time home buyer client buy their starter home. Well, maybe in 5, 10, 15 years, they're ready to trade up to another home. You're creating some predictable transaction opportunities proactively in your pipeline, while also serving clients that deserve to be served well and deserve to be able to best utilize the benefits that are available to them through their service to our country. So there's a ton of benefits when it comes to this. Now, for those of you wondering, well, how do I find these clients? Well, that's one of the strategies that, or the opportunities for us to strategize, if you'd like. but I'll just give a, for example, one of the agents on my team in Ohio, he's got a team with EXP Realty. He's in my EXP organization, and he is also now part of my NEXA mortgage organization. And he is strategically marketing to this audience. So utilizing Facebook and Instagram to identify eligible VA borrowers, and has put together some exclusive incentives and savings and so forth. And that's his niche. Now, he is also a veteran. He has helped and served over 250 now at this point other veterans in buying or selling a home. So he's got he's got the story behind that. But there are definitely strategies for proactively building an audience around this niche. And also, one of the things that you might incorporate into your conversational process when talking with clients, and one that we certainly incorporate, is asking the question, Jordan, would you be, are you eligible for VA benefits?
Yeah. So on our exploratory questions, if you don't ask, we do specifically.
Yeah.
So anybody that I've ever taught, it's like the third question. It's not even, I can't tell you how many clients that just forgot. I think it's not really explained well when you're in the military, right?
Yep.
If you serve 4 years, especially back at, 20, 25 years ago, some people will start converting to like conventional loans. Um, which it's not really as common nowadays, but 5 years ago, sometimes there would be situations where conventional might be a better option, maybe just to get that offer accepted, for example, in this market. But clients will forget about that, and they forget that they have a VA loan. So I always recommend to ask in beginning of any sort of question when you're dealing with a client, because you don't know. It does open up to a lot of opportunities for sure.
I've also had scenarios where they were older clients and just kind of forgot, right? Like they hadn't had a VA loan in a long time for whatever reason, and just asking the question, they literally were like, oh yeah, we could do that, right? And so asking that question opens the opportunity, and it also creates the opportunity for you to ask in the future who they know that might be VA eligible, right? It creates a referral opportunity as well. What about, this isn't directly on topic, but it's relevant. What are the rules and regulations for a VA refi? Because that's another possibility for
As long as you're
helping them
living in
grow.
a house, right? Yeah, as long as you're living in the house, you could do a refinance. There are some quirky rules about it, like the house can't be paid off if you're doing a cash out. Can't be completely paid
Yeah.
off. Has to have at least $1 owed on it. There's
Which
ways
we had
around it.
which Jordan has some
Yeah, there's ways around
yeah.
it. But it's just because we recently came up,
Yeah.
with that. Um, Besides that, you know, most of the rules on refinancing, if you have an existing VA home loan, is something that's called a streamline.
Yeah.
No income, no credit. Someone can refinance. Otherwise, that
That
people can
wouldn't
cash
be
out
that
up to
would
at
be
least
to
90.
lower the rate. That wouldn't be to cash out, right? So a little
Yeah,
bit
that'd be to
different.
lower the rate. But if we're talking about like using like investment strategies, like right now, veterans have a lot of money in their home, right? In general,
Yep.
right? Most homeowners do.
Yep.
Have some equity, they tapped into. You can pull out up to 100% on cash outs. All right. The norm is 90. Okay. You get better rates at 90. Your rate deteriorates significantly at 100 for VAs. But it's at least 10% more than any other product, right? That's going to be out there.
So
So
another
that's
strategy for using these your VA benefits would be, I'm in the home. I have no interest in moving, right? I have no interest in, I've already owned this home and I've got a bunch of equity. And I would like to buy a quadplex. I'm not going to move into one of the units, but I want to buy a quadplex or a duplex or a single family that I rented. But I don't have the liquid cash available for the 20 to 25% down. Let's do a cash out refi with those benefits and then use that for the acquisition to start or grow an investment portfolio. I mean, Matthew or Rebecca, or maybe it is Matthew, Rebecca, I'm not sure, sorry. Can a veteran cash out refi with bad credit? They've used a VA loan in the past.
Yeah, I mean, they could definitely refinance. Cash out refi, it just depends. Um, Depends if the system will accept them, right? There's technically not any credit requirements for VA home loans, but we do run a system called automated underwriting. The system typically says yes or no, right, on these. And hypothetically, it'd be done. But to get the system to say yes, it's really like a 600 credit score, a lot of times, or 580 at least. So if I was going to put a number on it, I would say 580 or more. But right now, I have a loan that's, someone's buying a house and they have a 557 on VA. So there are situations where, it can, if there's enough equity in the home, and maybe they're only cashing out up to 50% loan to value. That's a win-win for the bank, right? If they end up, losing that house, the bank will take it and they'll sell it for more money, most likely. But just depends on your equity position and different factors. But it absolutely
They're
can
not
be.
going to get the 90% max
Yeah, they're
refi
not
with.
gonna they're not gonna be able to max out on it, theoretically speaking. But the term bad credit, a lot of people think bad credit is like 600 credit score. That's not bad credit. Bad credit's like 580 and below. That's bad credit in mortgage world. 640 is normal. That's normal credit. Good credit is above 660, 680, 700. As excellent credit's like 800. Perfect credit's 800. So
You bring up a good point. This isn't related. This isn't specific to VA, but just generally speaking, when we're having conversations like Mike, we have several agent partners that we co-market and collaborate with, and Mike will, on a fairly regular cycle, will be having conversations and setting appointments and getting applications from interested borrowers. And when someone says they have bad credit, that may or may not be true in the reality of from a qualification standpoint, because to a person, they may think 660 is bad credit, when in reality, 660.
720 is bad credit and tell me they have bad credit. Their credit's
Yeah.
bad.
So you've got to
So
ask, when that comes up, asking good questions will uncover and allow you to overcome potential objections or obstacles that may not even exist, right? They have been, so there may be someone that you've talked to that says, well, for example, one of our best performing text scripts, this works like gangbusters, is the following. What's the one thing stopping you from buying your dream home this spring or this summer or this fall or this winter? And by far, one of the top 3 replies we get, if not number 1, is my credit. Well, the follow-up is, do you know what your credit score is at currently, approximately? Because they may have a misconception about the required credit score to qualify for a mortgage. And if you're the one that asked the additional question when everyone else stopped trying to help them when they said, well, I have bad credit, and to them, they thought 680, or like Jordan said, 720 is bad credit, you may have someone that's ready, willing, and now able to qualify, that no one asked a follow-up question to uncover that opportunity. Matthew, they want to consolidate debt and have a lot of equity. Matthew, sounds like we should get together. And in fact, Mike, can you set up Matthew with co-branded mortgage application links and email those over and CC both Jordan and I, so we get Matthew an easy way if he wants to refer that client to see if we can help them with a cash out refi. That would be great.
We have another Q&A. We'll get to in a second, but one more thing I want to, point on that. I owned a credit repair company for a long time, 5 or 6 years.
Mm-hmm.
Thinking about putting it back together, but I don't think I have enough time. We'll work on their credit. I mean, if someone's a 557, right? And a lot of times it's, when they're debt consolidating, it's maxed out credit cards, stuff like that. The guy that's purchasing a house that I have purchasing a house is currently behind on his credit cards, late payments, and he's buying a house.
Yeah.
Okay. So there's rules surrounding this, stuff that allow veterans to get them in better positions. So I don't, if their goal is to, okay, they got a ton of equity and they're trying to settle on debt, get debt taken care of, that's usually easier than even just trying to go purchase a house and add more debt. He's selling a house so he can pay off all of his debt. He's moving house to house because that house is just too much for him. They're downsizing. They're like 80, right? We're in the middle of the process right now. And he just couldn't keep up with his credit cards after his wife passed, right? We're helping him get into that next position. So it's definitely doable. I just want to point to, like, don't put him out there. We'll work on credit if it's not.
The point is, don't assume by whatever they share that we can't or won't help them. It may be that there is a simple solution or an easy workaround, or it may be that we have to give them a plan that is going to require some work and effort on their part. But if they execute on that plan, we'll be able to help them at some time, either in the near or longer term future. But if you have someone that is ready, willing, and able, and they're motivated and they'll listen and take action, we certainly will do everything possible to help them in whatever form or fashion. We pride ourselves in playing the long game with this and helping as many people as we can, regardless of whether or not that means we're getting, a mortgage or a loan today. Steve asks, I have a low rate VA loan that I wouldn't want to lose the low rate with a cash out refi. How about just doing a HELOC to get the liquid down payment for an investment property? Absolutely. Absolutely.
Well,
and
I want to point out one thing here, not to cut you off, Josh. Everything is mathematical, no matter what it is. Okay. It depends on how much money you owe and how much money you don't owe. I think a lot of people focus on, I have a 3% rate. They focus on that. But Steve, let's say you owe $150,000, right? Let's say you owe $150,000 on, 3%. And then I turn around and look at it and you're trying to pull $200,000 at 12%. It doesn't make a whole lot of sense. I might as well take you a VA and do a 6% and see what the cost is versus both loans. So there are situations where that won't actually make sense. So I always tell people, it depends on how much you owe, depends on what it is, but most likely pulling out a HELOC is going to be the better option. But they're just at higher interest rates, right? You got to be careful. You got to be careful how much you're pulling, and especially they're at adjustable rates too, right? That's the other thing that you have to keep in mind. They'll adjust over periods of time, and they'll go up a lot of times with HELOCs also. But depends on how much you're turning that money. Maybe you're doing fix and flips. Depends on what you're designating for it as well. That could make that not an issue anyway, right? It's something that you want to pull from multiple times and flip 5 homes over the next, year or 2 years.
I'm going to brag on Jordan here because this is something else that Jordan is wonderful at breaking down and presenting with you or your clients, is in black and white the comparison of those two scenarios and helping them make the decision that makes the most sense to their total financial picture. You know, the picture in totality, and not just a limited view of one, you know, one piece of the puzzle. It's how does this work together?
I think a lot of originators look at, I'm not saying they're all in it for the money, but they look at it's like, oh, I have a loan, right? They, you know, they get jittery that, hey, I have a loan, and they're not looking out, okay, what's the full scope of this? So I try to make sure that, hey, this makes sense. What is the overall payments? Because the easy option would be to throw in a HELOC, a 5-day HELOC in it, you know, in Steve's face and say, hey, pull this out, good, we'll make our money and we'll move on in 5 days. The route that I suggested would take 30, right? It's you know, more work, effort on my end and Steve's end. But it might be better for him, and that's what's important.
And I did throw the 5-day HELOC link in Steve's face as an easy place to start. So
Yeah.
just a quick side here. We have a 5-day online HELOC. It's a simple online application. It's kind of like a credit card app. The reason why I think that's a good place to start in a scenario like that, there are several. Number one, it takes literally minutes to apply. Number two, it is only a soft credit pull. And number three, if there is, or if or when you get approved, you will be presented with different offers and options. And it's at least a starting point so that you know, okay, this is what, you know, an option or option might be. That said, we have many other, there are closed-end second mortgages we could explore, and we have many other lenders that offer HELOCs as well. It's just a matter of finding the best fit.
Well, it also give you a good idea on value, right? On AVM that they would use, you know, specifically.
Perfect.
Not that's
another benefit of the 5-day HELOC. You don't pay for a full appraisal. They use an AVM. Now that's a benefit. It can sometimes be a drawback because sometimes the AVMs aren't as accurate as a full appraisal. But you know, again, there's no harm in applying and seeing what options come back. Monica asks, what would be the first step for a veteran if they're already using a VA loan on their primary home and would like to buy an investment property? Well, number one, I would ask,
you know,
do
it
we have
depends on,
equity?
yeah, well, depends on what they're exactly wanting to do, right? Just like Steve's question, we could look at, you know, pulling a HELOC out and purchasing a home that way. Now, if we can't do that, right? If they're willing to move, right? Maybe they want to make a little bit of upgrade. You know, not that it's how do I say this without sounding like you're deterring people? A starter investment. It depends on what kind of home they bought first. Is it their forever home or not? If it's not their forever home, it might be just a stepping stone, and they can buy another VA home loan and then rent out their old property.
That would be the first question, right? Is this a home that you want to stay in, or should we consider keeping this one, renting it, and then seeing if we can use your VA benefits to buy a home to trade into? Maybe even a new home, a new construction home, right? I mean,
there's a lot of things you can do, but you can always end up moving back after a year if you wanted to. They're both VA home loans, right? You know, it's not like it's a primary. Just whenever you're moving and getting a new VA home loan, it has to be a primary residence for at least a year, right? So it depends if that's their forever home or not, and it makes sense, right? It can't be the house next door that is, you know, 3 bedrooms short and you got 2 kids, you know, right? It has to make somewhat sense if you're going to do it that way. Otherwise, we can pull the equity out of their current house and you know, with a HELOC. But the first step, if I was going to say any step, is just having a conversation of what overall that picture is and what their goals are, right? What is your goal? Goals? How do we come up with an investment strategy? And does it fit within what they already have, right, available to them? Or is it something they're going to have to work on and say, okay, maybe I can pull this much out, but I need to save $6,000 or $7,000 or whatever it is.
Mike, can you hook up Monica with co-branded links as well if we haven't already? Monica's name is ringing a bell, but if you can check to see if we have set her up, and if not, go ahead and set her up and send those over. Other questions, comments, scenarios, situations that might be useful for the good of the group for us to explore. All right. Well, we have a couple of folks that Mike's going to set up with co-branded mortgage application links. We're happy to do that with you or for you as well if you'd like. Just email mike@growwithjosh.com, mike@growwithjosh.com, or just reach out to me. There are at joshvips.com, we have several intake forms for different loan scenarios, DSCR, fix and flip, etc. You can also scan that QR code. That'll take you to the same place. And one other program or opportunity that we offer that we'd want to make sure that you're aware of is our dual license program, which is I am a part of that program. And it gives you the opportunity to earn revenue from mortgages without having to do the actual origination activities. You just refer. It works very much the same as you referring a client to a real estate agent in another state. You're referring the mortgage, and you get compensated for referring that mortgage, and it can be very lucrative. There is some work involved.
I want to. There's such a thing called a vertical business model. We do it with commercial loans and business loans, right? I'm in the space, the residential lending. I'm in the space, so it might as well offer commercial and business loans as well. It just makes sense. It's the same thing. You guys own the leads. You guys work for the leads. You might as well open up a vertical position on your business, and it's a lot of money when it's added up and put back into marketing. So,
if that's something you're interested in, reach out to me. You can schedule a time to chat at josh15.com, or you can go to wakeup.realestate/RELO. I will put that in the chat as well. There's a short video overview and a place where you can request a time for us to chat. TD asks, what if you're an investor and interested in how you can purchase homes with VA loans?
Well, there's only one way.
Right.
There's only one way you can do this, and is if you purchase it as your primary residence and you're able to assume the loan. So most government programs, FHA, USDA, and I know we've had classes over this, topics over this before in the past, but VA counts to that. You do not have to be a veteran to technically take over a loan that has a VA home loan on it. So it depends on how you're going after it. But if you're, let's say, I don't know what kind of investor or you're, self-sourcing your business, but I would always recommend ask them what the type of loan is on it. And if you're willing to move into that property, you could theoretically assume it. It just takes a while.
Which, by the way, another place that you can check out some of the past sessions that we've referenced several times. Go to wakeup.realestate, create your completely free account. And under this tab right here are mortgage webinar replays, which includes the one that Jordan just referenced. We talked last week about assumable mortgages, closed-end seconds, and HELOCs, and the strategies for utilizing those opportunities. You can also see we've done sessions on hard money and DSCR and non-QM, no down payment, FHA, whole bunch of stuff here. For those of you interested in that dual licensing reload, here is more of a deep dive. wakeup.realestate/RELO is a short overview. This is a deeper dive into how that works and the opportunity with that. I think now more than ever, as commissions are contracting and transactions are contracting because of low inventory, it is a wonderful way for you to increase your revenue without, or at least theoretically, without increasing your transactions, right? So it could be a wonderful opportunity for the right person, the right fit. We will, I said, get the replay of this up on our YouTube channel, Wake Up Real Estate, on our website, wakeup.realestate, and you can check out the on-demand replay immediately after at the Zoom link. We set those up as on-demand webinar replays. Jordan, as always, thank you for your expertise and your time and for playing hurt today. And we will be back next week. Hopefully, Jordan will be back to 100%. We'll be back next week with another mortgage-related deep dive session to help you have better, more educated, more knowledgeable conversations out in your marketplace, so you can turn more of those conversations into opportunities to serve more clients in your market and for your business. Thanks, buddy.
All right, I appreciate it. Have a good one.